Hello and welcome to the Investing Iguana, where we help you make smart financial decisions. I'm your host, Iggy, and today we're going to talk about the pros and cons of paying off your mortgage early. If you're a homeowner, you probably have a mortgage that you pay every month. A mortgage is a loan that you take out to buy a house, and it usually comes with an interest rate and a loan tenure. The interest rate is the percentage of the loan amount that you pay to the bank every year, and the loan tenure is the number of years that you have to pay back the loan. Now, some people may wonder if it makes sense to pay off their mortgage early, before the end of the repayment period. Maybe they have some extra cash lying around, or they want to save money on interest, or they just don't like having debt. But is paying off your mortgage early always a good idea? Well, like most financial questions, the answer is, it depends. There are some pros and cons to paying off your mortgage early, and you need to weigh them carefully before making a decision. Let's start with the pros. Pro number 1, it frees up cash to invest or pay down debts. One big benefit to paying off your mortgage is that it frees up a lot of cash. Once you no longer have a monthly mortgage payment, you can use that money for other things, such as investing in the stock market, saving for retirement, paying off other debts, or spending on things you enjoy. Having more cash flow can also give you more flexibility and security in case of emergencies or unexpected expenses. Pro number 2, you save money on long-term interest. Another advantage of paying off your mortgage early is that you save money on interest. Every month that you make a mortgage payment, some money is going toward interest, so the fewer payments you have, the less you will pay in interest. Paying off your mortgage early could save you tens of thousands of dollars over the life of the loan. For example, let's say you borrowed $450,000 for a 25-year mortgage at 3% interest. If you paid it off according to schedule, you would end up paying about $639,000 in total, including about $189,000 in interest. But if you paid it off in 15 years instead of 25, you would only pay about $556,000 in total, including about $106,000 in interest. That's a savings of $83,000. Pro number 3, you own the home outright. A third benefit of paying off your mortgage early is that you own the home outright. This means that you have full equity in your property, and no one can take it away from you if you default on payments. Owning your home outright also gives you more control over your living situation. You can sell it whenever you want, rent it out for income, or pass it on to your heirs without any complications. Pro number 4, peace of mind. Finally, paying off your mortgage early can give you peace of mind. You may simply like the idea of not having a mortgage hanging over your head. The freedom that no mortgage payments gives you is a powerful motivator. You may feel less stressed and more confident about your financial future. So those are some of the pros of paying off your mortgage early. But what about the cons? Well, there are some drawbacks to consider as well. Con number 1, you lose a tax relief. One downside of paying off your mortgage early is that you lose a tax relief. In Singapore, you can claim a tax relief of up to $15,000 per year for the interest that you pay on your mortgage for your owner-occupied property. This reduces your taxable income and makes your mortgage more affordable. However, if you pay off your mortgage early, you no longer have any interest to claim. This means that your taxable income will increase, and so will your tax bill. Depending on your income level and how much interest you were claiming before, this could be a significant cost. Con number 2, you may have to pay a prepayment fee. Another drawback of paying off your mortgage early is that you may have to pay a prepayment fee. Some banks charge a fee if you pay off your mortgage before the end of the lock-in period. This is because they lose out on the interest income that they were expecting from you. The amount of the prepayment fee varies depending on the bank and the type of mortgage that you have. Some mortgages allow you to make partial repayments without any fee, while others charge a percentage of the outstanding loan amount as a fee. Before paying off your mortgage early, make sure to check with your bank if there are any prepayment fees involved and how much they are. You don't want to end up paying more than what you saved by paying off your mortgage early. A third disadvantage of paying off your mortgage early is that you miss out on higher returns by investing. The average mortgage interest rate right now is around 1.5%. This means that for every dollar that you put toward your mortgage principal instead of investing it elsewhere, you are saving 1.5% in interest. However, you could potentially earn more than 1.5% by investing that dollar in the stock market, a business, or another asset class. The historical average annual return of the Straits Times Index, for example, is around 7%. This means that for every dollar that you invest in the stock market instead of paying off your mortgage, you are earning 7% in returns. Of course, investing is not risk-free, and there is no guarantee that you will earn 7% or any positive return in any given year. But over the long term, investing tends to outperform paying off debt, especially when the debt has a low interest rate like most mortgages do. So by paying off your mortgage early, you are giving up the opportunity to grow your wealth faster by investing your money elsewhere. Con number 4, you have less liquidity. A fourth drawback of paying off your mortgage early is that you have less liquidity. Liquidity refers to how easily and quickly you can access your money when you need it. Cash is the most liquid asset because you can use it right away for anything. Other assets like stocks or bonds are less liquid because they may take time or incur fees to sell or withdraw. When you pay off your mortgage early, you are converting your liquid cash into an illiquid asset, your home equity. Your home equity is the difference between the value of your home and the amount that you owe on it. If you own your home outright, your home equity is equal to the value of your home. While having more home equity is generally a good thing, it also means that you have less cash available for other purposes. If you need money for an emergency, a big purchase, or an investment opportunity, you can't just tap into your home equity easily. You would have to either sell your home, which could take months and involve commissions and closing costs, or borrow against it, which would mean taking on new debt and paying interest. So by paying off your mortgage early, you are reducing your liquidity and making it harder for yourself to access your money when needed. So those are some of the cons of paying off your mortgage early. As you can see, there are trade-offs involved in this decision. There is no one-size-fits-all answer. It depends on factors such as A, your personal preferences and goals, B, your financial situation and budget, C, your tax implications and deductions, D, your opportunity cost and expected returns, and E, your risk tolerance and time horizon. Before deciding whether to pay off your mortgage early or not, you should do some calculations and comparisons based on these factors. You should also consult with a financial planner or advisor who can help you evaluate your options and make an informed choice. That's all for today's episode of the Investing Iguana. I hope this video was helpful and informative. If you enjoyed it, please give it a thumbs up and subscribe to our channel for more financial tips and tricks. And don't forget to leave a comment below and let us know what topic you want us to cover next. Thanks for watching and see you next time.